I am telling you guys, it's not really that difficult. It's actually pretty simple. But the reason why you guys are unable to become profitable is because you're not able to adapt, and you get fixated on the idea that, hey, there's relative equal highs up here. Why is the market driving lower? I should be looking for buys. I take a buy here, I take a buy here, and the market keeps pushing lower. That is why I preach the idea of not having a fixated bias and just allow yourself the opportunity to look for buys and shorts at any given day. Just look for the right areas. There is an obvious hourly level waiting here at the red line that we discussed on the hourly chart. If we get acceptance below it and we get a pullback into a breaker block with fair value gap, the probability dictates that we're going to continue heading back lower, and it's going to be a very, very smooth ride. The most accurate IPDA trading strategy. What you're looking at is the Nasdaq on the hourly chart. When I do this, you should now be able to see where I sold the market today, which was up here, and I exited my position down here through this low. And what you're going to learn today is one of the most accurate trading strategies. You're going to be trading this from 8 a.m. all the way up till 11 a.m. New York Eastern Time. And I'm going to give you a few seconds now so you can pause the video, draw the market out for yourself, because I'm going to be revealing the drawings and we're going to be diving into the specifics of this trade that I took today. So I've presumed you've paused the video. Now we're going to be revealing what I had marked out today. Various levels. For this strategy, I use the hourly time frame for bias and direction, and the 1 minute time frame for execution. Those are the only two time frames that I look for. The very first thing that you see is obviously the levels that I have drawn in, and what I do is I draw every closing of fair value gaps and liquidity pools that I see and that I think are likely to be tapped within my trading session, which is the drawn liquidity video that I recently uploaded. Covers that very in depth. Here we have highs, so that's why there is a level there. Here, this is a closing price of this fair value gap, so there is a level there. This is obviously a sell side liquidity pool. The same goes for this and this. Now, once we've identified the levels, it becomes rather easy moving into the lower time frames. So the only thing that you need to remember now is that I had this level drawn in, which is a sell side liquidity pool and possible rate acceptance area for the market to move to the next sell side liquidity pool, which is to say, if the market were to accept below this low, there's a high degree of probability that we're going to be going for the next liquidity pool, which is obviously here. So once I see confirmation that we're trading below this area, I then zoom into the 1 minute and look for an entry into the next liquidity pool, which is the exact trade that I took. Let's dive right into the 1 minute. I guess we're going to be seeing things more clearly as we do so. Remember, this is where I come into the charts, 8 a.m. and 11. This is where I leave. Now, this is the same level that we spoke about on the hourly. I don't draw any levels on the 1 minute unless I am looking for execution levels. Then I will do it on the 1 minute, such as this one here, which was my execution level. But besides that, the blue and red levels are all hourly time frame levels where I think the market is likely to be drawn to. So when I saw that we were not breaking above, and this is where the idea of flowing with the markets actually comes in, and so many people get it wrong. You don't have to come into the charts, especially if you're scalping like I'm doing with this model, thinking that I'm only going to be taking buys or I'm only going to be taking sells. No, because you're scalping. You don't know where the market is going to go, and you need to make sure that you're ready for both scenarios. If the market were to have accepted above these highs here, let's say we drop down to this liquidity pool, we then accept above this high, I would have looked to get long here with the target of the next hourly level, right? But instead of the market doing so, what it did is move down. So I adapted. I knew as the market was coming down that there is a level here that I need to pay attention to, because if we were to accept below this area, I am willing to buy a breaker block here, which is to say I'm willing to sell at the breaker block low to target the next hourly pull. Once again, we're using the 1 hour time frame for direction, and we're using the 1 minute for execution. So this level here, once again in red, is an hourly level. And as soon as we accept it, let's see over here. Let's actually zoom in a little. We know already that this is the hourly level on the hourly. As soon as we closed below for several candles, once again, a single closure is not acceptance to me. And this is something that I will cover in a course if I ever drop one. But this right here is clear acceptance, that we've closed below the hourly level and that we're ready to move lower. Now, as soon as we saw that, you're then looking for a fair value gap, order block, breaker block, whatever it is that you use to get short. You could have gone short over here and traded that lower, or where I got short, which is this breaker block, because I thought this was more substantial in terms of the actual rejection that it provided and the short-term move away before the new low. So basically the market structure looks like this. This portion of the block is your breaker, and that's why I decided to go short there. Now, where does my stop loss go? Because a lot of people are still confused with this. My stop loss does not go above the swing, guys. I'm not a fan of it. I don't think it's smart. I think it's actually rather stupid. You are going to get stopped out more often than not. And if you are going to get stopped out, you are going to see the market then quickly turn back down. Now, in this case, you could say, yes, my stop loss was close enough to this swing for that to possibly happen. But I'm not basing my stop loss because there's a swing there. And that's what gives me peace of mind. I am placing my stop loss above this thrust. Why? Because this is one candle, as you can see over here, part of this 3 candles that went lower and close through the structure point here. Now, ideally, your stop loss should have been here, above this initial thrust, which is what initiates this move lower through the breaker, retest from below, move back lower. But I didn't think it was necessary, and I thought a stop loss above this thrust was clearly enough for the market to tell me that I'm wrong, because the market shouldn't really be getting up there if my 1 hour bias, which once again we know from the hourly time frame, is that we need to go short. So the market then felt me here. Now with NYC at 930, it got a little bit jumpy, and all these gaps that you see, I don't see them on my broker. This is just the Pepperstone liquidity feed provider on the left hand side. So even though there's gaps here, I don't experience them on my actual broker, which is what I'm executing on. The market then pretty much came close to take profit, reversed straight back up into the entry, and then it met lower. Now, am I frustrated because the market went ahead and it's on its way, more than likely, to the hourly liquidity pool that we spoke about here, which is the ultimate goal here, where we can look to go long below this area? No, I'm not, because I'm trading my module, and the way that I'm doing is I'm always targeting the next available H1 liquidity pool, which is in this case down here. Obviously, this was the next hourly liquidity pool. If we looked to the hourly time frame, you will see that we accept below this low. We know that the next area the market is going to gravitate to is here, and this was indeed the target for the trade. Now, you will have to accept that some trades are gonna run a lot lower if you're short than you intended to or you expected to, and you're not gonna be in the move, and that's perfectly fine, because it's very, very difficult, and I don't think anyone is able to capture every single piece of the cake. It's pretty difficult. The module is simple. There's 2 or 3 more setups that you can trade with this module that I'm not gonna cover today. I just wanted to show you the rate acceptance idea, how you can flow with the markets, because it's very important that you're able to adapt. There is no good, once again, as I covered in the beginning, of saying, hey, I'm only going to be looking for longs, I'm only going to be looking for shorts. At least if you're scalping, I don't think that's important, because when you're scalping, direction is changing constantly, and being able to adapt is going to make you a much more successful trader, in my opinion. So once again, as I said, when we go back to the hourly time frame, you will see that let's get rid of this here, that I was looking for a long here if we were to accept above this high and target, once again, the closing of the fair value gap that I spoke in the beginning of the video. But since we never really traded above there, and if we go to the 1 minute, we'll see it, which is the size here, I didn't take any long positions. But the important thing to notice is that I was aware that if this happens, I need to be long on a pullback with a target of the next hourly level higher. Now, I was also aware that, obviously, if the market were to break lower, that I needed to be short at the breaker for the market to move into the next hourly level. It's pretty basic stuff. It's not really complicated. It's really simple. The hourly chart as a bias and direction with the 1 minute, especially for scalping, works very, very well. It's very, very accurate. And you can do some testing on these types of setups on any other asset classes, even any other markets, such like the FTSE, the DAX, indices in general, and you will see a lot of success. I guarantee you that. You just need to be able to identify the hourly levels of interest for you, how you're going to be trading them when the market gets there. Because remember, as the market is here, you're not doing anything, guys. You're not anxious that you need to take a position. You're not worried that the market is not yet here or here. You're simply waiting, because remember, the market is only going to move up or down, and it's either going to go up to this level and you're going to be able to potentially take a trade, or it's going to go down to this level here and you're going to be able to potentially take a trade. So hopefully this breakdown was helpful, and I'll see you in a future video.